So, hi everybody. I'm Giacomo. Today I'm again with Marc Chandler. He is a political economist. He has been a host on Bloomberg, CNBC, and other channels multiple times. So, Marc, thank you for being with us today. Introduce yourself, and then we'll jump into the topics of today that are macroeconomic topics.
Good, thanks. Thanks for inviting me. So my name is Marc Chandler, and I've spent my career in the U.S. primarily helping businesses and asset managers deal with the foreign exchange market. My job is basically I do a lot of commentary and analysis and coming up with strategies for clients so they could figure out. A lot of our clients aren't speculators, but they're corporations trying to hedge their exposures. And so it's a challenging job, and I enjoy being able to view what's going on in the world.
Okay. So let's start out from the US and the latest reports. Last week, we had the unemployment rate report for at the start of April. Can you tell us a bit about the report, what was said, and how that can influence the Fed and the economic policy of the US?
Yeah, sure. So like you mentioned, the first Friday of every month, the U.S. reports the labor market situation from the previous month. So we just now had the March report, and even though the headline number missed expectations, the back months were revised higher. So overall, the impression one gets is that the U.S. labor market is very strong. The unemployment rate itself fell from 3.8% to 3.6%. And at 3.6% is interesting because the Federal Reserve last month in March said that it wasn't going to fall below 3.6%. It would stay there, 3.6% this year and next year, even though they anticipated the economy to slow and for them, the Federal Reserve, to raise interest rates relatively aggressively. And so this is where the sort of disconnect. A lot of people in the market didn't believe that both would be true, that the Fed would be raising rates aggressively, the economy would be slowing, but the unemployment rate would not rise. But overall, the thing to keep in mind about the U.S. employment data, it differs from many other countries because there's really two surveys. One is the establishment survey. That's where the Bureau of Labor Statistics calls upon businesses. How many people did you add to your payrolls? But then there's a household survey. And there they're calling up people at their homes and asking them about their employment situation. And so sometimes you get these two different aspects of the report. The unemployment rate itself is done from the household survey, while the non-farm payroll number that captures the headlines, it comes from the establishment survey.
Okay. So you in your blog, you have written a lot about the rates that are increasing and what that means and how this influences the exchange rate that the dollar has with all the other major currencies. Can you tell us a bit about the Fed policy, what we can expect going on? For example, today we have seen the markets drop a little bit. Is it reasonable to have fear right now that the rates are going to get higher and higher?
Yeah, so that's actually what the Federal Reserve has been signaling to us, is that their commentary, and that's why I think that people like myself, we pay attention to what politicians and officials are saying because they shed some light on the direction of policy. And so the Federal Reserve officials have been sort of encouraging the market to expect more aggressive tightening than previously. And so you think about it, coming out of COVID, and then we have this war in Ukraine, and prices have jumped. Inflation is very high in the U.S. And next week, we're going to get the next CPI report, and it's likely to be well above 8%. 8% year over year CPI in the U.S. And so the Federal Reserve, in light of that strong employment data we talked about, another jump in inflation, and the Federal Reserve thinks it's going to have to raise interest rates aggressively. By aggressively, typically the Federal Reserve moves in 25 basis point increments. But the signals we're getting suggests that the Federal Reserve is going to be moving in 50 basis point steps. And so we don't have a meeting this month in April. We have a meeting in May and June, and both of those meetings are expected to result in 50 basis point increases. And then there's 4 more meetings after that in the second half of the year. And the market's pricing in, out of those 4 meetings, 3 of them to be 25 basis points and 1 50 basis points. So this is, if you look back at the American history, recent history, you'd see that this is a very quick pace of tightening. And I think that what this means, on one hand, is the upcoming economic data, like that CPI number next week, or the industrial production, retail sales data. Those numbers won't mean quite as much. Because it might mean something for if you're trying to trade from home on a headline or something. But for the market as a whole, I think it doesn't matter so much because the Federal Reserve is perceived to have begun really a campaign that brings the Fed funds, our overnight target rate, from 0 to what they regard as a long-term neutral rate, which is between 2.25% and 2.5%. And so I think that the Federal Reserve is signaling this, and they're not only signaling raising interest rates, but as you mentioned before, the balance sheet has come into play as well. You know, during the crisis, both the great financial crisis and COVID, the Federal Reserve, like the ECB, the European Central Bank, other major banks around the world, they were buying their own bonds, called it quantitative easing. And that phase is over for the US. The US has stopped buying bonds. And now the question is, what should they do with so they buy a bond and it's going to mature. What should they do with those proceeds? Up until now, they've been reinvesting them, buying more bonds. But probably starting next month, they're not going to recycle the full amount. They're going to hold some back. And as they hold some back, what that means is that the balance sheet's going to shrink. And as the balance sheet shrinks, many people think that also imposes a tightening bias, a tightening like impulse, if you will. So what that means then is in addition to the price of money going up, raising interest rates, the quantity of money, the Fed's balance sheet will shrink. And so this tightening, many people like myself are concerned that it's going to lead to a recession, not right away in the US. We still have a lot of momentum, a lot of built up momentum that should carry us into the rest of this year. But the problem is that it's not just monetary policy that's tightening. In the US, we've got fiscal policy tightening very dramatically. And by dramatically, I mean the deficit in the US is going to go from over 10% to closer to 5% of GDP. And this kind of magnitude of fiscal tightening, smaller budget deficit, tends to also act as a brake on the economy. Because a lot of times government spending turns out to be somebody else's income. And that income is used for consumption, oftentimes. And so we have not only monetary tightening and fiscal tightening, but another regularity, if you will, in the market seems to be that the US economy goes into recession after you have a doubling of the price of oil. I know, if you're driving around in a car, and I'm very happy to tell you, my car in here in the US, I get 60 miles a gallon. That's like 30 kilometers a gallon of gas, so for a few liters. And so it's a very efficient car, but I have a lot of friends who drive these SUVs. And the higher price of oil, the higher price of gasoline means that it's more expensive to live. And so the higher price of oil, maybe the accountants tell us it's inflation. But my house, my family, your family experiences higher gasoline prices, higher petrol prices, higher oil prices, higher gas prices as a tax. And the more money we have to spend to heat our house or to drive our car, the less money we have to do those other things that we want to do. Buy new clothes, go to restaurants, go to a sporting event. And so what happens then is that monetary tightening, fiscal tightening, the doubling the price of oil, gasoline, you have a big squeeze coming to consumption. In the US, last month in February, the last month we had the data for, and we'll probably see it again when we get the next batch of retail sales data, that if it wasn't for gasoline purchases, overall, other retail sales are falling. So we're spending whatever additional income we might be fortunate to have on energy and food, and not for these other things. And so that's what concerns us about about the trajectory of the economy, that the Federal Reserve is going to raise rates until something breaks. And what's going to break is going to be the economy. It's going to be us. You know, the U.S. consumers are 70% of the economy. We're going to break first. And so that's what I'd be looking for in the upcoming reports, is that the Federal Reserve is on autopilot. They're marching rates towards neutrality, 2.25%, 2.5%. But what I'm watching to see when will the Fed stop is when we break, when we really see a fall in consumption. So that's probably the most important economic variable to be watching as you try to play this game from home.
Okay. Yeah, and I want to mention what you said the last time, where you said that every $10 more of the price of oil for every barrel goes up, it shaves off. It makes the inflation grow something like 0.2% and shaves the growth 0.1%. Right?
Yes, that's true. That is a rule that our Federal Reserve, our central bank chairman, had talked about in one of his testimonies. That a $10 rise in the price of oil lifts inflation by 0.2, but shaves growth by 0.1. So that's really the two blades. You get the slower growth, and the war in Ukraine is just adding to those pressures. It's both lifting energy prices, as you experience in Europe, as we experience here in the U.S., higher energy prices, higher food prices. And at the same time is going to weaken our economies, as we see already in the survey data that's being done since the war began. Higher prices, weaker growth.
Okay. Can you make a similar comparison? Can you compare what the Fed is doing with the other major central banks like the ECB, Bank of England, and so on?
Yeah, sure. So in some ways, maybe I'm sitting here in the U.S., so maybe it's this American attitude, but I think that the U.S. just does things more aggressively and bigger. And so both on the easing of rates, how aggressive we were with government spending, how aggressive the Federal Reserve was in buying bonds. And likewise, when we're turning off the tap, we appear to be on a path that's going to lead to more aggressive tightening than in other countries. So at the far end, so on one side, I'd say U.S., but on the other end would be countries like Japan and Switzerland, who are resisting raising interest rates, who are still adding on to their balance sheet. And they've made it very clear that they have no intention of raising interest rates anytime soon. And then maybe after them, maybe you have the ECB, who is still buying bonds. Their balance sheet is still expanding. And we expect from the ECB next week, as they meet in early April, that they will likely give us more indications about when they'll stop buying bonds. Because this is kind of important, is the sequence of events. When can they raise interest rates? Only after they get done buying the bonds. So it's important then for investors and for businesses to know, well, when are they going to stop buying bonds? And as of their last meeting, they said they will be buying bonds through second quarter. That's through June. And they said in Q3, we'll have it data dependent. And I think what the market wants to see from the ECB is for them to say, no more buying bonds. We do not plan on buying more bonds, but we'll keep the option open if necessary. Something that gives us a sense that they can stop buying bonds in June, which means that they could raise rates in Q3 and then probably raise rates again in Q4. And so the market does see the ECB ahead of the Swiss National Bank, ahead of the Bank of Japan, likely to raise interest rates, could be up to zero. That's the amazing thing. When you think about raising interest rates sounds very harmful to an economy, but we're talking about raising the deposit rate at the ECB from minus 50 basis points just to zero. And as you know, Europe is having a big bout of inflation like the US is. And so if you adjust those interest rates minus 50 basis points for inflation, you have a very deeply negative real rate. And the same thing is going to be true when the interest rate goes to zero, maybe late this year. Some other central banks, though, might be ahead of the US. The Bank of Canada meets next week. And Canada has a booming economy. Higher commodity prices helps them, so a positive terms of trade shock. They have high inflation, rising inflation, more so than officials expected. And the market is saying they could raise rates 50 basis points in early April when they meet. And so they might be a bit ahead of the Federal Reserve. They also could begin letting their balance sheet shrink a month ahead or so ahead of the Federal Reserve. The Bank of England began off quite aggressively, raising interest rates, but they've sort of pulled back a little bit. So in the U.S.'s case, maybe this illustrates the difference too. The Federal Reserve acknowledges the uncertainty, and because of the uncertainty, they want to bring back policy to more neutral settings. The Bank of England sees a lot of uncertainty as well. And what they want to do is they want to take their foot off the brake a little bit. A few weeks ago, the market was pricing in a strong chance that the Bank of England would raise rates 50 basis points when they met in May. And now the market's saying that there's maybe less than a 1 in 4 chance of them doing so. So the market is taking the signals, again, like we do with the Federal Reserve, or the ECB, taking signals from what policymakers say and try to translate that into prices or level of interest rates in a world in which it's not black or white, but it's probabilistic. And so we say that it's not that the Bank of England won't raise rates 50 basis points, it's just that the odds are against it. And so you say they have a quick overview spectrum of central banks, where they sort of are, with the US being aggressive and likely to raise rates more this year than maybe any other central bank except for the Bank of Canada.
Okay. And another thing that I want to talk about is, of course, commodities. So we've seen at the start of the conflict the prices of commodities going straight up, but now they are kind of on a certain plateau where they're just looking at what happens and they're going to move based on that. In case of a resolution of, let's say, a deal between Ukraine and Russia, for example, you talked about the kind of markets that are benefiting from the increase of value in commodities, like South America, and other emerging countries that are not benefiting, like Southeast Asia, that have not that large reserves of commodities. Could you, what is your take on these emerging markets, and could that go the other way around if we reach sort of an agreement, a deal with Russia?
Yeah, so it's kind of interesting, right? And so even before the war began, oil prices were elevated, gas prices were elevated, and partly this was, and as well as some food prices, and partly this was really a function of some droughts, bad weather. I mean, that's sort of what I think irks me. Not only the human tragedy of what's going on in Ukraine, but what a distraction. I mean, it's sort of like the old saying about Nero fiddling as Rome burns. This is like the earth is burning, and these kids cannot get along in the sandbox, which they've been fighting over for generations. It's not just now Putin and Ukraine, but there's been wars for centuries over the same piece of territory. And like our generation hasn't figured out a way to resolve this or learn from the other mistakes. But I do think you're right that commodity prices were already firming up and have accelerated to the upside. Many of the commodities, which really is a good reminder of how important economies are. Ukraine, Russia, whether it's metals, the three types of big categories, right, that we think about: energy, metals, and foodstuffs. And it's not just wheat that a lot of people focus on, but it's also like palm oil, fertilizer, which is, the last time we had a big spike in the food prices like we're experiencing now, we had the Arab Spring. And that is when people, especially poor people, where higher food costs and higher energy costs really hit hard, as it uses more of their income, a higher percentage of their income, it can lead to political changes. And all political, I hear you. I know that a lot of people are not happy with the status quo, but sometimes political change could be in a different direction than we want. And I think that's the danger of what happens with the higher food and energy prices, how it hits this within societies. But I think that broadly speaking, I think you're right too, that if there was to be a ceasefire, a lasting ceasefire or a truce, I think that you'd see some of this unwind. But I think the question becomes, and I think the U.S. has been purposely ambiguous about this, is if there's a ceasefire or a truce, how fast will these sanctions unwind? And if they don't unwind very quickly, for example, say Russian oil, uh, what happens? I mean, it won't keep prices elevated for longer. I mean, it matters how long these sanctions will last after the truce. But frankly, I wish I could be more optimistic about this. I sort of see Ukraine's demand to have its security guaranteed by countries like Poland or the U.S. itself is seen. I don't think that's a real serious negotiating demand. It seems reasonable. I mean, it's like, hell, this country's been invaded. Why should they get a security guarantee? But I think that it's too much like being a part of NATO. NATO members get these clauses of defense, of like joint defense, and I think that that tells me that Ukraine is not really. I think Ukraine thinks that they can still win the war. They can push the Russians out, and so why should they negotiate? I think that, like, if we really look at who wants to negotiate in a war, tend to be the people who are losing. And I think that Putin, we've turned this into an existential crisis for Putin. He might have thought it was just going to the cookie jar a third time, right? He goes into Georgia, not too much happens. Goes into Ukraine the first time in 2014, takes Crimea. People could cry about it, but nothing really happens. And now he goes in for a third time, and it's like the mousetrap snaps on his fingers. And I think we've turned into this existential crisis for him that he needs to have a military victory before he can really negotiate either. And so I'm afraid that we're going to be at this. At first, I thought it could be perhaps like others, that it could be relatively quick, and maybe a truce could be found relatively easily. But it doesn't look like it. I think that this is going to be with us for the second quarter, as we're just beginning it now. But I think that time works against Russia. The warm weather makes it going to make it harder to move people and munitions, and so it could be like hunkering down. But what we've seen happening is it's almost like a cornered animal, right? Which is why, like, all the military greats, like you go back to Sun Tzu, always encourages to lead your enemy a way out, because there's nothing worse, nothing more ferocious than like the trapped animal. And unfortunately, that's what we're seeing happen, I think, in Ukraine as Russia pulls out of some areas.
Okay. And yeah, so you explained your concept pretty clearly. I want to add to that the Secretary General of NATO today, I think Stoltenberg said that we should expect the conflict to go to be longer than what we previously expected. And aside from that, I want to talk about broader politics around this topic, because it seems like there's more and more polarization of countries. It looks like we're getting into a big divide between East and West of the world. We can see India, for example, that looks closer to Russia now. And what are the likely consequences of this? Another example is Saudi Arabia having more tighter, let's say, ties with China and agreeing to sell their oil with Chinese currency and so on. What do you make of that, and what is your point on that, on this bigger issue, let's say?
Yeah, no, it's like this is really the great game, the big global strategy of the competition between nation states. And so, many people, including myself, thought that we were headed for what we thought was another Cold War. But we thought it would be, of course, we thought we had it like more in our minds as something geared towards the East, and especially China, and as it is a sort of a provocateur in the oceans, among its neighbors, and so people like me written about like a second type of Cold War with China, and in such a scenario, it didn't seem like the world was so divided. It looked like China was fairly isolated to basically countries that were really like they didn't quit the West. They sort of were evicted. I think about like North Korea, maybe Iran, and so China didn't have. I sort of thought China was more isolated. But you raise a good point that against the Western sort of liberalism, another bloc is forming. And that bloc, of course, partly China. China, of course, is the biggest, wealthiest, strongest. But Russia, India is an interesting role here. And that's why I think when I look at the sort of global chessboard, I'm looking for pieces that can change sides. Because I think pieces that can change sides, like we know that Canada is not going to change sides. We know that we know that France, Germany, Italy, they're not going to change sides. So who can change sides? Well, there's a couple of players that are sort of mixed. In Europe, say Hungary. In East Asia, you're right. I think it's India, but India is kind of a complicated position because it has had long-standing ties with Russia, including weapons development. And you know that big air defense system that Turkey bought from Russia that caused so much grief. The U.S. put sanctions on Turkey over this. That India bought the same system and from Russia, and Russia, we know, as you say, India is willing to buy Russian oil. They pay rupee, even though they still set it at $1. The dollar is a benchmark, and then they just make the conversions into currencies. So the dollar is still there, even though it's sort of less of a formal role. So what happens, and this sort of the paradox of this, right, is that we think that Russia and China are good friends. Meanwhile, Russia sells India weapons that India uses to fight the Chinese on the border. And so what I'd say is that some positions are like solid, you know which block they're in. Some seem to be playing both blocks or have a foot in both blocks. And I think those have become interesting countries. Turkey, NATO member, but still seems to think that it can arbitrate between Russia and Ukraine. Hungary, deeply, I mean, it's an EU country. And yet the EU is taking actions against it that could deny it as much as 40 billion euros in aid because of Hungary's alleged violations of core EU values. So we have these countries. I think that maybe that's what's going to be the interesting and the challenge for the phase ahead of us, is what to do with these countries that sort of in between. Can we win their hearts and minds? Venezuela, closer to in the U.S., maybe the higher price of oil, the need for U.S. to secure lower oil prices for both political and economic reasons, that maybe there's an opening for the Venezuela to get back in part of the fold, should we say. A thing that I wrote about last week was the Solomon Islands off the east coast of Australia. So they've been Australia's sort of been a part of a protectorate for them, if you will. And now it looks like China is making some inroads that'll let China have bases in the Solomon Islands, which is like outflanking Australia and New Zealand. And so these are important developments. But from a day-to-day sort of perspective, they don't really change about how we make these investment decisions. I think that for me, they provide this overall context for what's going on in these moving pieces, which then gives us other opportunities.
Okay. Do you have a take on Middle East? Because it's another region that have always had one feet on one side and the other feet on the other side. Can you make a little bit of a blueprint of the policies that Saudi Arabia, UAE, and Qatar are applying in this circumstance?
Yeah, it's a kind of another one of these complicated positions in a way, right? Because on one hand, the Saudis, the Middle East oil producers, they get dollars for their oil. They have been doing it for a generation. And the dollar is the benchmark. I mean, imagine if you were selling oil and you had to look up, you had this huge, you had to take a lot of currency risk. You're selling oil and you got to take all these different currencies. Much easier to do it with a single currency, almost like a natural monopoly, if you will. But on the other hand, there is a genuine difference of opinions, perceptions. Whether it comes to, the U.S. Trump pulled out of the nuclear deal with Iran. Biden is trying to negotiate a way back into a deal to limit the Iranian nuclear development. This is not, the Saudis and the Iranians have proxy wars against each other. When President Biden has this big meeting between democracies and for democracies, and it's casting the world as democracies versus authoritarian governments. Like, where does that put the Middle East then? And so I think that there's a natural conflict of interest, and there's also a material and economic conflict, right? The U.S. wants low price for oil, wants low price for gasoline. In fact, some people would suggest that President Biden's support is so low, the lowest since he's got in office, partly because gasoline prices are so high, as if Americans have this entitlement to low gasoline prices. And so I think that the Saudis, of course, and the Middle East as energy producers, they want to get a higher price for their oil. And over time, the combination in the U.S., the U.S., for 10 years it's taken, but the U.S. has exploded back onto the world scene with its fracking and its new way of getting oil. And what does it take how did the U.S. able to do this? I mean, becoming much more energy self-sufficient and exporting oil. So first, it's a certain attitude towards the environment. I mean, in New York State, where I live, we have the geological formations that have fracking. But we, the citizens of the state, say we don't want to have it here because it's dangerous, it's bad for the environment. So the first thing that fracking takes is a certain attitude towards the environment. The second thing it took was cheap capital. And then the third thing it took was these technological breakthroughs. And so this was a huge competition for the Saudis and the oil exporters, driving the price very, very sharply lower. And so now that on this side of things, what's happened is Saudi Arabia has finally, OPEC, in their own interest, has formed a bloc, sort of a gentleman's agreement, if you will, between OPEC members and non-OPEC members, especially Russia. And this helps the large oil producers coordinate their production. That's a strategic goal. That's like a long-term goal, because where do these countries like Saudi Arabia get their money to spend, including on defense, from the oil sales? And for many countries in the Middle East, there's only a few that have that capacity to build more. Many countries haven't invested enough, and some countries are frankly just running out of that oil that you can get to by just sticking a straw in the sand. And so Russia and the Saudis have this agreement, a strategic deal that works out in their interests, and doesn't work out in the U.S. interest. But I think that's sort of the battle. But I think that in the big picture, it's not clear to me that the Saudis, who don't want to be bossed around by the British like they were in the 19th century, they don't want to be bossed around by America and are going to one day just turn over and say, okay, Russia, tell us what to do. I don't think it's going to work quite that way. But at the same time, I think that there still is this, it's sort of like, when we have friends, we want to be able to like our friends for everything that they do, for what they are. But when it comes to politics, I think that there could be some agreements. So we say to the Saudis, we'll sell you the weapons, the defense weapons you need to protect your pipelines from these drone attacks. And we'd like you to consider lowering your price of oil, but they're decoupled. They're two different issues. And I think that we as individuals, we want to link these issues together. And I think that the diplomats, the statesmen, separate these issues so we can still have some agreements and some areas to disagree. And I think that's it's not a very clean picture of like black and white. I'm afraid that's really the way a lot of these large countries really are. That we can be like, I guess we call them frenemies. Right? We can be partly friends and partly enemies.
Yeah. Okay. I think you explained it pretty clearly. And what is their, let's say, thought process behind their policies, because we see it only from our point of view. Yeah. So I'm done with the questions. If you have anything else you want to talk about, you're free to do so. If not, I really want to thank you, Marc, for being with us and letting us to have all your insights and your point of view.
Thank you very much. I enjoyed chatting with you. Very informed.
Okay. Thank you a lot. So this is it for today. I'm Giacomo. This is Hustle Hub. See you next time.